This is a discussion about the accounting concept of expenses. And I'll talk about expenses in the context of a trading business. And a trading business is one where stock is purchased from suppliers and then resold to customers. And we'll use the example of clean cut mowers, which buys ride-on mowers from its suppliers and then sells those mowers to its customers. So it sells mowers. That's its revenue activity. Now have a look at this profit and loss statement on the left hand side. It's for July 2018. This business has sales of $20,000 and it ends up with a profit of $9,100 at the end of the month. Let us identify the expenses. In this particular business, over the course of July, there are two expenses. The major one is cost of sales, $10,000. Cost of sales, $10,000. This is the major expense of any trading business. This represents the cost price of the stock which is now being sold. That was the stock that generated $20,000 worth of sales. The cost of that stock to the business was $10,000, and that's counted when it's sold. So cost of sales, $10,000. This is a significant expense during July. In this example, there's only one other example of an expense, and that's office expenses, $900. That might include stationery, postage, anything to do with running the office. So this business has expenses of $10,000, the cost of sales, plus office expenses, $900 for the month of July. A good general explanation of expenses is that they are incurred to earn revenue. Expenses are incurred to earn revenue. And expenses will work to decrease profit. The higher the expenses, the lower the profit. The lower the expenses, the higher the profit. So expenses will work to decrease profit. Now we know that net profit belongs to the owner. And if expenses work to decrease profit, this will also work to decrease owner's equity. And this is demonstrated by the transfer of net profit to the owner's equity section of the balance sheet at the end of the reporting period. In this example, $9,100. If expenses had been lower, then profit would have been higher. So expenses have worked to decrease the profit, which of course decreases owner's equity. Let's look at a simple definition of expenses. Transactions that lead to a decrease in owner's equity, excluding drawings. Let's look at an example. Paid wages, $500 cash. And let's have a look at that transaction and its impact on the accounting equation. Assets will decrease by $500, and that will lead to a decrease in owner's equity, $500. The accounting equation remains in balance. Assets down $500, owner's equity down $500 due to the wages expense. So it has led to a decrease in owner's equity. It's not drawings, so it certainly meets the definition of an expense. Wages is certainly an expense. A more comprehensive definition of expenses is this: a decrease in an asset or an increase in a liability that leads to a decrease in owner's equity, excluding drawings. Let's look at the same example and then apply it to the accounting equation. Paid wages $500, cash. Assets will go down by $500. We've spent money from our business bank account, assets decrease $500, so there is a decrease in an asset. So part of the definition has been met. It also leads to a decrease in owner's equity, in this case $500, due to wages expense. So it has led to a decrease in owner's equity. That's another part of the definition. It's not drawings, so it fully meets the definition of expenses. That is, a decrease in an asset, which has led to a decrease in owner's equity, and it's not drawings. Let's now test some transactions and see whether or not they meet the definition of expenses. Come back and see video number 2.